Good morning and welcome to this Monday, July 26th, 2021 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're starting a new week. Last week, which historically is a very bearish week, got off to a horrible start, but we did rally Tuesday through Friday and finished the week higher, not only higher, but we also finished it at record high levels across the Dow Jones, first close above 35,000. The S&P 500 first close above 4,400. The NASDAQ 100, all four finishing all-time highs. Still got work to do on mid caps and small caps, but it's hard to be hard to be bearish when you've got those four major indices all breaking out new highs simultaneously. We'll talk a little bit on the makeup of the sector performance last week, but it too was bullish and suggests that this move to the upside is sustainable. Back at the beginning of the year, I think the S&P 500 was around 3,700. I was looking for 4,700 this year, and we're not that far away. And even if we get a little pullback in the summer, which I still think is a possibility, although breaking out the new highs certainly argues maybe for higher prices. But even if we do get a pullback, September historically is the worst month of the year. We still have to get through that. I think we're setting up for another big rally in the fourth quarter. I see the interest rates back down again today. We're remaining near historic lows. We're going to have strong growth. I think that bodes very well for stocks. And if we can just work our way through these headlines, which from time to time can be pretty bearish sounding, I think we'll be just fine. But we will probably need a bridge to get between now and the fourth quarter. We'll see how the rest of the summer evolves. Rarely do we just go straight up during the summer. It happens, but normally we get a little bit more choppiness in the summertime. So I think, as more and more of these companies report, more of the tech companies report, we've got some big reports coming out, not just in technology, but also consumer discretionary this week. We've got Apple, Tesla, a number of companies that obviously could have a big influence on the major indices. Those companies will be reporting. I think Amazon comes out later this week as well. And Amazon, after recently breaking out, we'll see how far it can run before the sellers take over in the near term. But all of the action in most of these big name, high capitalization stocks, most of the action has been pretty strong. And I think that bodes well for the market. This morning, futures, this was probably 10 minutes ago or so, but Dow futures were down 100, S&P was down 11, and I think NASDAQ was down about 33. So close to about 1/4% drop at the opening bell. Those of you who follow my historical work know Monday's typically the worst day of the week. Last Monday, of course, was horrible. Coming out of options expiration, and then we rallied the rest of the week. And looks like this morning we may get off to a little bit of a negative start, and then we'll have to go from there. Going to get into a lot of earnings. Number of companies will be reporting or have reported this morning or will report later today after the bell, maybe tomorrow morning. We'll talk about some of those later in the show. But first, I guess let's go ahead and I'll take you over to Earnings Beats for those of you who are new. And I'd love to have you join us over here. We have a free Earnings Beats Digest newsletter. Simply click on or simply go to earningsbeats.com and then type in your name, email address in the area provided. We'll get you set up as part of our community. This is a free newsletter, no credit card required. You can unsubscribe at any time. It's published Mondays, Wednesdays, Fridays. I try to make it pretty educational, but also focusing on the things that are important to us at Earnings Beats, obviously earnings, but also relative strength. That's a biggie as well. So if you'd like to start with that free subscription, just go to earningsbeats.com. Make sure you fill out that name, email address, hit that subscribe button. We'll get you set up. Looking back at the action on Friday, the Dow Jones Industrial Average, as I mentioned, closed above 35,000 for the first time in history, 35,061.55. So I know a lot of the big names, the large, big cap tech names are getting a lot of the love here of late. But the Dow Jones closing above 35,000 tells us it's more than just those technology names. S&P 500 also up, closing above 4,400 for the first time, up 44 points, more than 1%. And the NASDAQ up 152 points, breaking to a new high, up more than 1% as well. Mid caps and small caps both did well, but you can see still well below the highs set a couple of months ago. So still some work to do on the mid caps and small caps. Mid cap growth stocks did do well last week, though. Communication services leading the pack. I'm a little nervous with the internet group just on the long-term weekly chart. Same goes with the communication services, just very stretched, but still looks good. I mean, money continues to rotate into the space. And so in the short term, we got a lot of momentum going in that area, but longer term, we have come up quite a bit, not just in communication services, but really being led by the internet stocks. Utilities, big day on Friday. We haven't really heard too much from the utilities of late, mostly sideways consolidation, but July's been pretty strong for utilities. You can see the big move up off that 63 low, got up to about 66.5, pulled back, and then Friday jumped more than 1.25%. So nice day for the utilities Friday. Consumer staples and healthcare, a couple defensive groups also did well on Friday. Staples jumping 1.2%, breaking to a new high. Healthcare continuing to strengthen. Healthcare has been very strong of late and continues to do some good things here on its chart, breaking out more than 1% up on Friday, breaking out above that 130 level. Very strong action there. Energy, it's been the opposite. It wasn't that long ago. Energy was leading the market. And now it's trying to hang on for dear life. Got some really good support down around 46. Like to see that level hold. Watch that declining 20-day EMA. That is where we are failing currently. But you can just look at this going across here and you can see the rotation that's been taking place. So energy gets hit in July, but healthcare is good in July. Staples have been good. Utilities, good. Communication services broke out. Of course, technology and consumer discretionary been doing well. I'm going to talk about all of those sectors in just a moment. Let's first talk about the 10-year Treasury yield. This morning, we are seeing the yield down a bit, down just maybe 2 basis points, back to 1.27%. One thing that has been fairly consistent over the last 7 weeks is that the yield is remaining below this declining 20-day EMA. So even in the middle of July, when we got that nice little pop, got up to back over 140 on the yield, could not get through the 20 and then went to a new low. Had the big reversal on Monday last week, bounced back, still not able to get through the 20. So I think at this point, financials, industrials, which had been very strong all the way up until early June, these are two groups that struggle when the yield is moving down. Financials, you've got banks, you've got life insurance, investment services, asset managers. Those types of companies tend to do much better when rates are rising, especially banks and life insurance companies. And so as the yield has been moving down, you can see that's been taking a toll on the financial group as a whole. Also, industrials have been moving lower. A big problem in the market, if there's one really big problem, there's two really big problems. I don't think they offset all the really good things going on in the market, but the two really big problems, number one is the yield dropping. If you study history, you know that the stock market does much better when yields are rising. Not when they're astronomical and rising, but when they're low and rising, there's nothing wrong with the yield moving back up a bit because it's signaling rotation out of treasuries. And so when yields are going up, treasury prices are going down. That is what generates that rotation over into equities. And so many of the best moves on the S&P 500 during a secular bull market is when the yields are going up. I mean, if you go back and look from November when we got that positive vaccine news through March, we had a big rally. Now there's a lot of rotation, and some of that rotation hurt certain areas of the market, but overall the market went a lot higher. And normally what we see when the yields are coming down is a much more choppiness. Now, we are in a downtrend on the yield, but as I just mentioned at the top of the show, we've got major indices breaking out to the upside. We're in the summertime. If the yields don't start to come back, I suspect that will hurt the market at some point. It's very hard to pinpoint when the selling is going to kick in. I mean, last week was a perfect opportunity. We were coming out of options expiration last week, historically one of the worst of the year. We got off to an awful start on Monday, and yet the balance of the week, yields rose and the market came roaring back. So trying to time it, I mean, obviously we'll be looking at some of our short-term signals to try to time it as best we can. But I would be really surprised if the next 2 months through August and September, we just keep going higher, because that just isn't normally what we do in history. Now, when you're in a secular bull market, you're not going to see the summertime weakness that you see in a secular bear market. So I'm not expecting, September to be some sort of collapse, but maybe inflation continues to be high for the next couple months. And maybe that spooks the market. Once we get past earnings season, we know the third calendar month of a calendar quarter, those are the months we need to worry about. So that's March, that's June, that's September, and that's December. So those are the 4 months to be careful about. So when we get to September, if we've still been rolling pretty good in the market, we may want to be a little careful there. But industrials also struggle with yields coming down. And one of the reasons why, if you think about why would money go into treasuries to begin with? Why would yields go down? Well, money's going into treasuries. Why would money go into treasuries? Well, just the market's a little bit more defensive. A lot of times it'll have to do with the potential of not necessarily economic weakness ahead, but maybe not as much strength as what was previously forecast. So anytime the yield is going down and money is going into treasuries, it could be signaling something about the economy. Well, if the economy might be going down, if that has anything to do with why the yields are going down, then it makes sense why industrials would go down, because transportation stocks reside in the industrials. And if the economy is going to weaken, one of the first things to go would be transports. And that's what we've been seeing. So the two problems that I have, two things that keep me up at night: yields dropping, transports dropping. Other than that, I feel really bullish about the market. And I'm not overly bearish. I mean, the yield ran from, 0.5% to 1.75% in the span of about 7 months. So I think pulling back for a period of time is not the worst thing. I didn't think we'd go below 140, 150. So I'm a little surprised we've come down this much, but I'm still, bullish overall the market, despite the fact that yields have come back down again. The other thing you have to keep in mind too is when you've got the economy strengthening, typically what you think of is, okay, the economy strengthening, that's going to trigger inflation, which is then going to force the hand of the Fed to begin to raise rates. Well, if somehow you can have strong growth without inflation, it does not force the hand of the Fed. And that's really what we're in right now. I mean, we've got inflation in the short term. Transitory numbers are looking, pretty high. But the way the stock market's trading, it's trading as though it's not worried about inflation. And the Fed's saying, don't worry about inflation. So that's the theme that I'm seeing in the market. And I think that's a part of the reason why the yield's coming down is that, yes, growth is still going to be there. But anybody who's been building a model suggesting that inflation is going to be a problem, I think is probably going to have to start adjusting their model. But let's watch these reports coming out over the next several months on inflation. But I believe it's transitory. That's what the Fed's saying. And I really think that's what the charts are saying. All right, let's move on to the sectors. So I don't know if you saw this, but members of Earnings Beats, I send out a weekly portfolio report every Sunday. It went out a little late yesterday, yesterday evening. Normally I try to get it out somewhere around noon, 1, 2 o'clock, something like that in the afternoon. So it did go out later. But one of the things I just focused on when I looked at what was going on with the S&P 500 was this is a 1 week look at the sector performance. So last week started rough, and then we came roaring back 4 days in a row with gains, breaking out to new all-time highs. Well, I like to see what kind of leadership we're getting on those kinds of moves when we move to all-time highs. And I want you to look at the 1 week performance of the various sectors: communication services, consumer discretionary, technology, healthcare, and industrials. Those 5 groups led the market to the upside. Very solid gains, especially communication services, discretionary, and technology stocks. These right here, these 3 are the 3 that I look to the most when the market is going higher. I like to see these groups breaking out. So we've got all 3 breaking out with the major indices breaking out, and these 3 leading the sectors. It's hard. It's really hard for me to be bearish when I see this kind of action. Why would Wall Street be pouring their resources into these growth areas if inflation is a problem? Why would we be breaking out on the backs of the 3 most aggressive sectors if something bad was about to happen in the stock market? I can tell you from history, this is not the way tops form. Tops form when these groups begin to underperform as the market keeps trying to move higher. So the fact that we've got leadership coming from the right areas makes me feel really good, and also makes me feel like the yield's going to eventually reverse back to the upside, and we're eventually going to see transports moving higher again as well. But looking at the bottom for the week, utilities, real estate, consumer staples, these are 3 defensive groups. Energy, here's your materials. These are groups that really are just more what I call neutral. I don't think they tell us anything about the market. They live in their own little world. They've got a lot of different things. They've got geopolitical concerns that can impact them. They've got the US dollar is really a big factor in how they perform on a relative basis. They can lead bull markets. They can lead during bear markets. I don't really see any kind of real correlation between the performance of materials and energy and the direction of US equities. So I don't really pay a whole lot of attention to them. When the dollar is weak, you want to be in them. When the dollar is strong, you want to stay away from them. Generally speaking, I'm not saying that's all the time, but that's a pretty general blanket statement. And then the only other group down there in the bottom is financials. Of course, the yield tumbling over the last couple months really having an impact on the financials. The banks, which were strong, they've been down. Some of them at pretty key support levels. So you may look at some of those banks with the yields down and many of their prices down. But longer term, right now, the market just doesn't appear as though it's concerned about the high growth that's going to take place because they don't believe inflation's a problem. All right, looking at the sectors on an absolute basis, let's go through these charts. So first, we've got the XLK. Breaking out, if there's one negative, it's breaking out with a negative divergence. But you see this a lot of times. Anytime you get a big move up in an index, you pull back, test the 20. Chances are when you first break out back to the upside, you're going to have a negative divergence. And that's why, for me, divergences are secondary to price action. So I've got the XLK breaking out, volumes picking up on Friday. We get a new high. Yes, there's a negative divergence, but we don't know how far this is going to run. I think sometimes when we react too quickly to the negative divergence, we cut ourselves off to the possibility of a big advance to the upside. Many times, like I said, when you break out, you'll have a negative divergence. If we go back over here, look at this high right here. See how the PPO is higher, coming off of this negative level, rising, gets to this high, pulls back to the 20. When we first broke out right here, we had a negative divergence. But by the time we got up to this high, we had actually climbed above that prior high. Then we go sideways, 20-day test, breakout, negative divergence. Come back down, hold prior lows, and then we're right back up to new highs. I just think sometimes the divergences, they're important. They give us some good signals. I think they're much more important when you have other corroborating technical evidence to go along with the negative divergence. Like when I see a negative divergence, if I saw us go up another couple days this week, and then maybe Wednesday or Thursday, we gap up, sell off all day long and have a big bearish engulfing candle on heavy volume, and we still have this negative divergence in play with a reversing candle on heavy volume, that's when short term I'd grow much more suspicious and cautious. But it's almost, many times, it's almost a mathematical certainty. When you get a pullback and you break back out again, as you're breaking out, you're going to see a negative divergence. But I think you got to let this rally play out and see whether or not we eliminate that negative divergence. Because the last thing you want to do is to get out here with a negative divergence and then see the XLK another $5 or $10 higher and the negative divergence is gone. Then what do? Jump back in $10 higher? I think that's a recipe for disaster. So I stick with price volume first. By far, my number one indicator. Anything else I talk about is a distant second in terms of secondary indicators. All right, let's take a look at the XLY, consumer discretionary. I think I may have said it broke out. Okay, so this one did not break out. It went down to the 50-day, reversed on that Monday reversal we had last week. Big rally, though. Nice 5 days in a row, hollow candles. Good, solid accumulation taking place in the XLY. It does have a little bit of work to do to get back through that prior high, but it's right on the cusp. XLC, here was a breakout. And you can see there is a negative divergence in play. But volume accelerated. We made the breakout. I would be careful unless I get a reversing candle. I wouldn't be worrying at this point about that negative divergence. The XLF, sideways consolidation, got a double bottom in here at 35. It would be really good to hold on to that support area. All right. XLI, industrials, similar, double bottom, false breakdown, rally back. And I was mentioning the transports, so let me just bring up the transports here with the XLI. We closed at 14,756. The 20-day was 14,753. Now, maybe it's just a little head fake above the 20 and then back down we go. I don't know. But we are seeing the volume come back in on this rally. We did close above the 20-day for the first time since early June. So we're talking about seven weeks or so. So transports at least are starting to show some signs. We got the PPO back up above its trigger line. So it was below the trigger for about 7 weeks here. Tried to get through, back down below, been a little choppy. We're just now moving back above, and we're above that 20-day. So transports are looking better, but it's a little risky to jump in here. I did actually take a position in the IYT on Friday, just a little bit of a hedge, because I think if the market rotates again, I think transports could get a lift. We'll see. But I'll probably have a tight stop. I mean, if we break back down below the lows from middle part of last week, I will probably jump right back out, figuring I can catch it again at some later date. But, this is an area where I think we could begin to see the transport strengthen a bit. The XLV, has gotten really strong of late. And I'm going to show you the XLV on the relative strength because I think it's beginning to show a lot more relative strength on this chart here. So now you can see it had been downtrending for the last 14, 15 months relative to the S&P 500, but it did put in a bottom back at the beginning of April, and it's trying to take out this relative high here. So it's starting, this has been clearly the longest time of relative strength since back in the first few months of 2020. So we are beginning to see more strength. I'd like to see this break back up above the relative 50-week moving average and the relative PPO turn positive. But down here, the absolute chart has broken out and the relative chart seems to be strengthening. We'll see whether or not that continues. Let's see, let's go back. All right, so that's the XLV breaking out. You can see, again, negative divergence there. I still feel like we've got more room to the upside here. Unless you get a big reversing candle, I would be looking for higher prices in healthcare. Consumer staples, sideways consolidation just broke out on Friday to a new high. And you might say, well, that's not good. It's a defensive group breaking out to a 52-week high. Well, it's still underperforming. I mean, it's been going sideways here for the last 3 months. In a secular bull market, a rising tide lifts all boats. We want everything to go higher. We just don't want consumer staples to be the clear leader as we go higher. And I certainly don't think that's the case. Real estate also recently breaking out sideways, consolidating here, holding on to that rising 20-day EMA, still fine. XLU talked about at the beginning of the show, strengthening here in July, but it had been weak for a couple months. So we're seeing money rotating back, probably getting a little bit of a lift from the yield falling. Any income investors who are in treasuries, all of a sudden looking at those utility dividend yields in a much better light after the treasury yields have been falling. All right, last couple. Energy has rolled over. I would really be careful if this breaks right here. It's the 46 support. I mean, we would then be down back at a 6-month, not relative low, a 6-month absolute low in a secular bull market that's setting new highs. So energy being left back in the dust right now, and materials as well. Hey, I know these groups were doing well back earlier in the year, but even then I was very cautious on these. Said you want to be careful. If they start to lose any kind of bullish luster, you want to be out of them, because I still think the dollar is going to go higher. And if the dollar goes higher, the XLB and the XLE will lose ground on a relative basis. And if you want to see what this looks like, let's go take a look at energy and materials and what's been happening. I'm gonna back this up though. I want to go back like 9 years, because this has been going on a long time. Here's energy. We had the huge steep drop in 2020. Yes, it was strong, but it was almost a relative dead cat bounce. Now I'm looking at this relative chart as a possible bottoming formation. Left shoulder, neckline, head, neckline, right shoulder. And then the next move, if we can get the breakout, I think would bode really well for energy. And it probably would coincide with a weak dollar. So chances are, if we're going to get this pattern to confirm, then I'm probably going to be wrong about the dollar, because I just don't see this relative strength taking off to that degree if the dollar is strong. But so that's one thing. So you can see how the energy was doing well, but it started rolling over. Look at the long-term pattern. The dollar's been going up since 2011. Energy doesn't do well. Look at materials. Now, materials were much stronger. Let me go back, put this in for 9 years. And materials were much stronger on a relative basis. But as we were coming down, lower low, lower high, lower low, lower high, lower low, so far, lower high. And now look at it, completely falling apart. Materials, you really don't want to be in this group, haven't wanted to be in this group for the past couple of months. The group's not doing well. On a absolute chart, just looks like a little pullback, no big deal. But relative to the S&P 500, which is setting new all-time highs, you can see it's really tumbling on a relative basis. And that's what I think we have to be very careful about. All right, moving on. Stocks of interest. So here are some stocks from last week that I thought started to rally. At least a few of these I'll show you started to rally and beginning to show some nice relative strength again. Trade Desk, of course, had that big split not that long ago. Was it 10 for 1, something like that? Big, heavy volume. I don't remember when the split. It was sometime around, I want to say the stock was around $60, $62 when it split. Made the big move up, pulled back, looked like it was breaking down below the 20, had a nice recovery last week, and actually broke back out again. Look at the volume picking up on Friday. So Trade Desk looks very interesting here. Roku, also up, challenging, and I believe Friday was its all-time closing high. I don't know that it topped that high candle body on the open on February 16th, but I believe that was the highest close ever on Roku. And look at the volume pickup. So we got some game changers here, and these are growth stocks that had been lying dormant for a while. Snap came out with their earnings, blew earnings away, top and bottom line, sideways consolidation, now in the rearview mirror. Big breakout on heavy volume on Friday. DHI is what I was trying to type in here, which is DR Horton. We had been in a little bit of a, wedge, bullish wedge, nice uptrend, then coming down, squeeze in. Looks like we've broken out now on this, and we just opened. And you can see we're gapping up today, but DR Horton starting to look better. And look at that PPO starting to move into positive territory. Etsy. Etsy also strengthening, coming up off the 20-day, breaking out above the prior high. It looks like it's resuming its trend. A couple that didn't do so well last week. I'm going to look at NetEase. NetEase breaking down on Friday, and look at the gap down today. Stock down another $8 and breaking below this double bottom. Not good action on NetEase. VeriSign, however, broke out on not so great volume. This was a long period of consolidation, but then came out with their earnings, which weren't bad, but the stock sold off, went all the way back down, basically test these lows, 215 to 217, and then rallied back up. I think it's okay as long as it continues to close above 215. So I'd watch that on VeriSign. Went through a bunch of individual stocks, so we'll consider that the 3 you must see. Let me just go over a couple of earnings, and then we'll wrap up today. Lockheed Martin, LMT, just reported the numbers, $7.13 versus $6.51. But it's in the defense group. Lockheed Martin has not been performing well versus defense, and defense has not been performing well versus the market. So you have one of the worst performing stocks within one of the worst performing groups, and they just reported earnings this morning, which beat. Now let's get the update and see what they're doing. Down $7. I mean, this is why I use relative strength. When you look at the absolute chart, you might say, well, it's been rallying, looks pretty good, not bad. I'm going to hold it into earnings. I would look at the relative strength, and there is no chance I would hold it into earnings. Sometimes you get stocks that'll gap up with, poor looking relative strength. It's a kind of a dead cat bounce, sell on rumor, buy on news. So sometimes we see that, but I don't take a chance. There's a reason why Wall Street is ignoring these stocks going into earnings, and I don't want any part of them. So today we're seeing a little bit why on Lockheed Martin. Again, down $7, now $8.40. It's going to try to see if it can hold on to support around 368 or so. Otis also reported they beat. Now in this case, got a nice looking chart pointing up. AD lines broke into multi-month high. Relative strength versus the industrial machinery group, very strong, and the stock gaps up with earnings. And I believe this is one that I had pointed out to members last week when we did our Q2 earnings webinar. This is one of those stocks I liked to perform well with earnings. Another company, this one blew away estimates. So let's take a look and see what's going on with Hasbro today. Now, this one had not been doing very well. I mean, relative to toys, just kind of going sideways. But toys had been beaten up. So I wouldn't have been in this stock. And even with its great earnings, it reported $1.05 versus 50 cents. Even with great earnings, it's up nice, 5.8%, but it's still in this sideways consolidation mode. I wouldn't be surprised later today to see a sell-off just because we're, unless we can get that breakout on the close above, say, 100, we may test it. But at that point, if anything, I'd be selling or I'd be short until it can show that it can break out. All right, a couple of earnings coming out later today that I think are two of them worth mentioning. One is Tesla reporting after the close. Tesla is kind of an interesting, it had a little bit of a pre-earnings run, but it's been going sideways here in July. I don't know. It doesn't look like it's going to come out with a great report. It is starting to strengthen against the auto group, so I guess that's a positive. But autos relative to the S&P have been flat for a while. So mixed signals at best here on Tesla as we get ready to head for earnings. And then the other one that I really think is going to be interesting, CDNS, Cadence Design reports. And yesterday I sent out a special report to members about maybe 6 or 7 software stocks that you'll want to watch that could break out? Well, Cadence Design was one of those, and you can see it's been sideways consolidating in this 120-ish to 148-ish range, and we're at 145 basically right now with earnings on deck. So that could be a catalyst here for the stock to break out. All right, let me give you one more. LOGI. This is a stock that I think could come through. Had a big move back May to June. Even though it's been pulling back, the AD line is staying high. It's in a very strong group, computer hardware. It was leading the group just a little over a month ago, but during this period of consolidation, we've seen the relative strength pull back, and we're at a relative strength support area. So I wouldn't be surprised to see a good report come out on LOGI. We'll see. All right, that is it. Let's see what the market's doing before we wrap this thing up today. So we've opened up a Monday, and well, we got mixed action. We got the Dow up 28, S&P up 2.5, NASDAQ down 32. NASDAQ led last week. This week not doing nearly as much to the upside. You can see percentage down on the S&P 500. NVIDIA taking a little bit of a hit here. Small caps doing well today. Mid caps doing better on a relative basis as well. So all of a sudden, we've got money rotating back again in the other direction. I would say as long as rates remain fairly low, I think any pullback in these growth stocks is likely an opportunity. All right, that's it for me. Everybody have a great rest of your Monday. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. It'll be a recorded version, but that will air over at Stock Charts at 9 a.m. on Tuesday morning, 9 a.m. Eastern. All you have to do at 9 a.m. is go hit the Stock Charts TV. And at 9 a.m. or later, it will have my show playing, Trading Places Live. So keep that in mind. All right. Have a great day, and I'll be back tomorrow. Take care, everybody.